Today I'm breaking down two great setups and one terrible one that you'll definitely want to avoid. Welcome back to the channel, everyone. So first of all, thank you for being here. I truly appreciate your time and all the amazing feedback that I've been getting lately on my newsletter. For those of you who are new here, my name is Jonathan Andin and I'm a professional swing trader with nearly 10 years of experience in the market. And I'm also the content lead for The Fivers, as you probably already know, the biggest prop firm in the industry. And I'm also the senior market analyst for Prime XPT, and I'm the founder of Clarity Edge Analysis, where I share my personal research and trading insights. On this channel, I document my analysis, my trade ideas, and my journey as a trader. If you want to sharpen your edge and really see how a professional approaches the market week after week, you are in the right place. And please do not forget to hit that like and subscribe. It's just a small click from you, but it really does mean the world to me. And if you have any questions, feel free to drop them in the comments and I will gladly help you out by creating a video just for you. All right, so what we're going to be looking at first is USD CAD. This trade is a trade that I've been looking at for a very long time. I remember releasing the first newsletter based on this idea on around September the 13th. So this is on the daily chart right here, and September the 13th, I believe that was a Sunday, around this time right here. And the idea is based on an extensive analysis combining a possible long-term bottom on the DXY, the dollar currency index, compared with or in combination with seasonality patterns and the seasonality effect, especially on USD CAD. So let's first take a look at the dollar currency index. All right, so this is the dollar currency index right here. And as you can see, we have been traded within this long-term channel for the last 15 years or so, ever since the great financial crisis of 2008. And as you can see, price has been consistently using this lower trend line, this lower ascending trend line, the lower boundary of the channel, as a long-term bottom. On average, it has taken about 100 and I think it's around 150 days on average for the dollar to form a bottom. And if we do some calculations on that, we can see that we are currently, if we assume that the beginning of the bottom was, let's say here, we're currently at around 100 days, which means we have about 50 days left, on average 50, which means, you know, we have one bottom here taking 300 days, almost 300 days, this one about 300 days, so could actually be taking much longer than that. So this is the overall structure that I'm seeing for the US dollar, and I have been, you know, obviously seeing a lot of people being extremely bearish on the dollar. I'm seeing most analysts are extremely bearish on the dollar. Everyone's talking about more downside for the dollar. There is, of course, the possibility that that move is already priced in. Now, I have to be honest and say that a lot of people that I respect, a lot of fundamental analysts that I do respect in this space, are telling me that there's going to be more dollar weakness. So we have to have that in the back of our head when we're looking at this idea and really manage our trade accordingly. But looking at the technicals, I really like the US dollar here for a possible long-term bottom. Is it going to happen today? I don't know. Is it going to happen next week or next month? Obviously, nobody knows. And the idea, you know, the saying goes, strong convictions loosely held. And if you're new in trading, what that basically means is, as a trader, to succeed in this space, you need to make sure that you have very strong convictions in your trade to be able to really follow that trade when the time comes. But you also have to be very fast in, or very quick in changing that idea. You know, if the idea becomes invalidated, you quickly let go. So strong convictions, loosely held. You have very strong convictions, but if the trade idea goes against you, you're out of the idea. You got to cut your losses very quickly. That is super important. But so this is the framework that we're seeing on the dollar. Now let's go into the seasonality effect on USD CAD. So this is a very cool website called Seasonax, where you can find basically seasonality patterns within different markets. And we're going to be looking at USD CAD, because we're going to go to USD CAD and we're going to look at patterns. Let's see if we can find any patterns right here. And we have one from the 8th of September to 28th of November, 11th of September to 8th of December. Let's just take a look at this one right here. Okay. Now, if we look at USD CAD on this, a potential bottom around the 8th of September to a top in the end of November, or even, you know, to the end of December. But if you put it right here, you'll see that you have above 75% chance, which means for the last 10 years, 75% of the times the market has bottomed for USD CAD here. We can go to 15 years as well. You see 85% chance. Let's go to 20. Do we have 22 right here? 66. So, I mean, the dollar currency index channel that we've been looking at is about 15 years long, and throughout this period, over 85% of the time, USD CAD has found a bottom in September, with the very bottom on average happening around the 20th of September. Keep this in mind, because we're now going to go to the USD CAD chart. So this is USD CAD on the daily, and you can clearly see this important ascending trend line right here. We saw that price had a major push to the upside. Let's switch to the weekly. A major push to the upside right here, and you can see that the first push to the upside above this level, we broke above this resistance, which is around the 1.37 something, 38 maybe. We had a strong weekly fake out. Well, okay, it's not really a fake out, but you had a strong weekly breakout, and then in not too long, couple of months, you're not trading below the level. Same thing happened in 2020. So you had first in 2015, then 2020, and then you had the major breakout here again in 2024 after hitting that level repeatedly, a lot of times, basically weakening that level as support. You came down, started trading below the level, hit that trend line, and formed a range. I view this range as an accumulation range. We broke above that accumulation range, formed another range on top of that one, which I believe is a part of the same accumulation range, just showing added strength. My confirmation for this trade was basically the first confirmation would be a daily close above the range highs, and that's what we saw right here. Okay, so that's the daily close above the range highs is now confirmed. Okay, and then I wanted to see a daily open and close above the level to place orders on the retest. Now let me walk you through a little bit of my trade management and how I structure this trade. I'm currently in 2 positions. Of course, it's one trade, but I've averaged into this position. I'm fully filled on my desired risk. I'm risking 1% per trade on my funded accounts. The first funded account with the Fivers is connected to Trade Copier, and then I got accounts with FTMO, Alpha Capital. One more. I can't remember what. So okay. So what did I do here? Let's use the replay tool. Market broke out here. I can't remember exactly what caused the market to break out. That was a major news event, can't remember, but the market broke out here. And on that breakout, when we had that daily candle closing, I put in my first position around this area. Okay, so that was my first position. Now I am predominantly a break and retest trader. Then that means I first want to see a break above resistance, and then I want to go long if there's a confirmed bounce on the retest off that level, because a lot of times breakouts turn into fake outs, and even if they're not going to turn into fake outs, a move usually retests the breakout level before continuing. Okay, so I'm not really a breakout trader, but what I did was I bought this breakout with 50% of my desired position size, if in case the move was just going to continue straight up to the upside, right? So if the move just continues straight up, at least I'm going to make some money, right? But I don't want to be too invested into that breakout if in case it turns into a fake out or it resets the level and I could have gotten a much better entry. So the stop loss currently down here, and if I had that entry, that means the trade is going to be 1.6R. But what I did was, to get a better risk to reward, I placed another buy order, limit buy order right down here. I can't remember exactly what my order was here, but I think it was like somewhere around here. So the middle entry is going to be here. That's going to be 2.22 or something like that. And of course, a couple of days later, we saw that retest of the breakout level, and we now have a fairly good bottoming pattern, bottom formation here, and a bounce right here. Now, the reason why I have my stops very wide all the way down here was, first of all, I entered the first position on a Friday, so I really wanted to make sure I have enough space to account for any weekend surprises or any volatility that might come in on market open on Monday based on whatever. It could be development in Ukraine, could be development in Israel, Iran, it could be Trump just tweeting some stupid shit. Who knows, you know? A lot of things can happen over the weekends. I wanted to have a wide stop loss. I have not limited the risk on this one. I have not moved my stop up yet because I do see a potential of seeing a move perhaps all the way down here, right? All the way down here, and then a move up. And if that happens, I want to make sure that I have a wide stop loss so that I can later limit the stop loss and maybe put it up here, right? Or if prices break out here, I can now limit my stop loss to here. Now, the beauty of this, the beauty of swing trading this way is if price breaks out above that local high right here and it just continues up, what I do have now is a swing point right here, and I can now place my stop loss below that swing point. Okay, so let's say, for example, I limit the risk with 50%. So I'm drawing the fib here just to show you the middle point. If I limit my risk with 50% to here, I can then take that risk, what I reduced, and add it on the breakout. So basically what I'm doing is I'm raising my stop loss 50%, which means I remove 50% of risk. I remove half of that risk, which also means that I can now double my position and keep my risk the same as previously. So if I do have a breakout here and I have my stop here and that position, I can double the position size on this one, depending on where I get because if I have a breakout, I can now move the stops up here. I can double my position size and have a stop loss. Let's see, that stop loss is it's a 56 pip. The stop loss on this one about 65. So about half of the position sizes, but the risk to reward is way different. It now turns into 3R instead of just a 2.22 as the original. So that's the risk management and the trade management plan that I got for USD CAD. And then of course, if the trade just continues down, breaks that low and starts printing something like this, then I might just close the trade, because we got to remember the seasonality window is open till about the end of November, which would be around here. So this is the time window that this trade has to develop. We got about 60 days. If the market starts ranging and doing something stupid in this 60 days, and I see that it doesn't really have the necessary time to get up to that level, I also have to take into consideration the swaps, right? Well, we got to make sure that we're not paying too much swaps. And you can go into MetaTrader, go into the symbol, look at the statistics, see how much are you paying for the swaps to be long USD CAD, and make sure that you calculate that and how much it's going to cost you to have this position open for a week, and make sure that you're not paying too much on swaps. All right, so now that we covered what I believe is the most important idea, USD CAD, that's where I have most of my exposure, and that's the trade that I got the most conviction with. I want to also cover EURCAD, and this is also something that I've did cover in my latest newsletter, Declare the Edge. So make sure that you go in and subscribe to that one if you haven't already. All right, so the first thing we're going to be looking at here on EURCAD is the rising wedge that we're seeing right here. So we're first obviously seeing a long-term bigger rising wedge here with the white trend lines, and then we're seeing the green trend lines indicating a smaller rising wedge within this bigger one. Now, when writing the newsletter, I had my my trend lines right here, but if I just increase that trend line just a little bit to connect that one and that one, you see that I take into consideration the recent price as well. And trend lines, we have to, you know, view trend lines just in a similar way as we're viewing horizontal levels. They're not always perfect, so instead of viewing the trend lines as a perfect price level, we have to kind of look at it as something that's evolving over time, and imagine that there's some type of buffer zone around that level. Right, so we're first going to be looking at volume. By the way, indicator templates, the indicator templates in TradingView, fantastic. You can click that one and then save, you know, add all the indicators that you want and save it as a template, and then you can just move between the different templates based on the type of analysis that you're doing. Now we're going to we're going to start with the volume analysis. So I got a volume template right here, which consists of the volume bars right here, and then we're also looking at the OBV right here. Now, some things have changed since I wrote the newsletter, so that's obviously very important to note. But the overall structure of volume, you can clearly see that volume is declining throughout this whole pattern right here, as you can see by drawing this beautiful line right here. That it's definitely declining throughout this pattern. So price is showing us an uptrend, but volume is showing us a downtrend. And what does that mean? Volume is not confirming price. One of the most important ways to use volume in your technical analysis is to look for volume and price divergences. You want volume to confirm price. If there's an uptrend, you want to see increased volume, which means that market participants are enjoying the uptrend and they're buying more, and you get more volume and more buying power coming into the market. In this case, we're seeing declining volume, which means declining interest in the rising market. Less market participants are interested in buying the uptrend because there's less volume. And then we have the OBV at the bottom right here, this on balance volume. So the way that the on balance volume, the OBV indicator, is working is if you have a day with bullish volume, it gets added to the OBV. If you have days with bearish volume, it gets subtracted from the OBV. As you see right here, we did have the OBV breaking below the EMA. Now the EMA is not traditionally part of the OBV indicator, but I've just simply added an OBV on top of the I've added an EMA on top of the OBV, so I've added a 20 EMA on top of the OBV, and we saw that at the time of writing that first article, we did see the OBV breaking below that 20 EMA, and we also saw that we had like a double bottom and support here, and if the OBV could have broken below that support, it might have added extra confirmation to this idea. That didn't happen, right? So again, gotta remember, strong convictions loosely held. When we start to see signs that the idea is not confirmed, we are supposed to take the idea and just throw it out the window and start with a new one. No confirmation here on the OBV as I would have hoped for, but the volume is still in a declining trend. Now let's look at some MACD histogram and RSI divergences. We're going to look at the let's say we're gonna look remove the MACD, and I got this indicator right here. This is only the MACD histogram right here, and what I'm looking at is very clear divergences on between RSI and price. You get the RSI right here, have fairly clear lower highs, while price is giving us higher highs. And then we get the MACD histogram doing the exact same thing. Lower highs with price creating higher highs. This is a divergence between price and the momentum indicators, and that is of course a bearish divergence. Now if you take the fact that you got this bigger rising wedge, which kind of might turn into a channel here. I think it's the smaller rising wedge that's the most important one in terms of rising wedge patterns, and that's also where the targets are based on, and we're going to cover that in just a bit. So looking at this right here, we have confirmation with declining volume, and we have bearish divergences across the MACD histogram and the RSI. Now let's talk about confirmation and targets. The way you measure the target of a rising wedge or a wedge, whatever wedge, it's the highest point, like the beginning of the pattern. So this is the highest point of the beginning of the pattern, where the first high was created to the first low. And what we can see here is we're looking at a fairly big move of around 2%, or a 355 pip move to the downside. Huge move, right? Now what I'm looking at here is I'm also looking at the lower trend line right here, the lower trend line area, as a potential target. I have an alert on the lower trend line of the potential rising wedge right here. So if price moves down like this, I'm gonna get alerted, and I will then potentially go short on that breakdown. Maybe, you know, see a retest of that level. Now of course we have no idea if this is going to happen, but I'm just showing you the levels that I'm looking at in case it actually does happen. So breakdown, hit that level, it goes short here, stops probably above the pattern depending on what price is showing us. But if we have a clear rejection within this area right here, then, you know, we might actually wait for the move down, enter at market here, move the stop all the way above that high. And then what I'm looking at is the conservative target would be a hit of this lower ascending trend line, confluent with that low right there. That's the conservative target. But the measured move would be all the way down here. So we're looking at a move all the way down here. That would be the measured move of the rising wedge. So that would be a huge trade. We're looking at a 300 pip move to the downside. So that's what I'm looking at on EURCAD, but it needs to confirm first, and there's no confirmation. Let's look at the weekly. What are we seeing on the weekly? Well, we are seeing on the weekly that EURCAD is trading in an area that it has not been traded in since March of 2009. Chances are that, I mean, if you look at the overall pattern for EURCAD, and we can do kind of like a just look at where most of the price action is. Most of the volume traded in this market and most of the price action is absolutely not up in this area. So the mean reversion trader in me and the looking at the statistics of how likely is it that EURCAD is just going to go straight up and start trading up here? Not very likely. If you look at the historic price action, it's more likely to eventually see a move down towards the mean price, the average middle, or the average price, the mean price would be, I believe, somewhere around here. So a pullback, it looks like the market is ready for pullback, but it's also very important to remember that a bull market can stay bullish way longer than you think. Okay, so the RSI can be oversold for weeks and weeks and weeks, and you know the saying, the market can stay irrational longer than you can stay solvent. Basically, you look at the market and say like it shouldn't go higher, well then it's going to go higher, you know. So it's very, very important in an idea like this that we wait for proper confirmation before taking a trade. All right, so finally let's end this wonderful video with a failed trade idea, and let me walk you through why this is a failed idea. I remember marking it in my journal, not according to plan, because of this very reason right here. Right, so we looked at volume right here, and specifically the OBV. Now the OBV was a crucial point in the analysis of this trade. Now the whole analysis of this trade was based on this idea, right? Based on the fact that GBPCHF is testing a level that it has not been trading below since 2022 in COVID, right? So during the pandemic, we had a whole another market structure, and it has tested this level for quite a few times, but it never really broke below. Last time it happened 2022. So we're testing that level once again, and we looked at the market on, I believe, Friday. Was that Friday? Yeah, so Friday candle closed bullishly as a first sign of a potential bottom, you know, first sign of this low acting as high time frame support. And then we had this descending trend line right here. I added the short reload zone as well. Took the fib from that high to that low. That creates the fib levels up here. And basically what I'm looking at here is, okay, so if this is going to be low, I'm thinking prices could very well come up and test that descending trend line. And if it happens quickly enough, might hit the area where the 50% fib and the descending trend line converge. Going into the 4 hour, we see a clear downtrend right here, and I'm looking at this downwards trending trend line that is keeping the downtrend intact. And I was basically looking at this. Okay, so I want to see a break and retest of the trend line. All right. And I pulled up the chart, I got an alert on GBPCHF, and I'm like, oh, it's happening, right? Because what I saw was this. And you look at this, you're like, oh, well, the idea is playing out. This is beautiful. This is perfect. I get into the trade without checking the OBV. So remember, one of the criteria for this trade was OBV. And if you go to OBV, the idea was to get the break of the trend line, while also getting a break and retest on the OBV. I wanted the OBV to break above the 20 EMA, and I wanted to see this. Okay, I wanted to see this, but the OBV is still in a very clear downtrend right here. And what we have right now is just the OBV continuing down, showing us that according to OBV, the sellers are still in control. What I did was I managed to get out of this trade around here, around the 50% down to stop loss, because I saw that price immediately went down. I looked at OBV and I'm like, this is not the trade that I plan to take. So that was a unnecessary loss and a lesson in discipline, and a lesson in not being too impulsive. As a person, my personality, I'm very impulsive, right? So I see a trade idea, I'm like, oh, this looks great, I'm gonna jump in, without really, you know, really going through the plan that I have. So a lot of times I make plans, and obviously the best trades that I've had is the ones where I look at high time frames and I make very detailed plans. And sometimes I forget to double check the plans before entering the trade that I plan to take, and those are all most of the time going to be losing trades and bad trades. So this is a mistake, but not a failure, because I've learned something important from this mistake, and that is making sure that you always double check your plans. Alright guys, that's it for today's video. Thank you for watching, and make sure that you do hit that like and subscribe and all that fun stuff, and let me know in the comment section if you have any questions on anything that I covered, anything that you want me to cover, or any questions on whatever. Let me know. thank you for watching, and more importantly, thank you for your time. Have a great day, and I'll see you guys in the next video.